let's get some facts. 37% of you aren't subscribed to this channel. That's almost 4 out of 10 just freeloading the alpha. So come on, hit subscribe and I promise to keep leveling up the show with the best guests and the juiciest insight. Go on, do it now.
Hey everyone, welcome back to Real Vision Pro. My name is Jamie Coutts, and today we have Charles Edwards, who's back on the show. He came on the show, I think, in November last year when market was actually on a pretty weak footing. I think Bitcoin was trading around 90,000 at the time. Since then, we've broken down to new lows. We're trading just above the highs from the 2021 cycle, around 72,000 currently. So it's a perfect time to bring Charles on because Charles, among many things, has been a long-term sort of on-chain quantitative analyst in the space. He's developed his own toolkit. He's got his own Capriole charts website, which I'd encourage people to check out. I definitely use that as part of my process. But he's also been highlighting some of the long-term risks to the Bitcoin protocol as he sees it. And so today on the show, we're definitely going to cover those things. But we're also going to get into the macro and what's currently transpiring, especially with the divergence between Bitcoin and other macro assets. So, Charles, welcome back to the show.
It's great to be here. Excited to discuss all those things. Thanks, Jamie.
Well, let's start with what the market is telling us right now. So, obviously, the big discussion at the moment is Bitcoin's underperformance versus gold. Now, I think you can say probably 40%, maybe even more now with the current price action year to date, or the last 12 months, I should say, while gold has ripped to new all-time highs. What is your general thesis about the reasons for the divergence, from your perspective, and how are you positioned given the current price action?
So gold's obviously had a massive tear. It added 11 trillion last year. The global money supply went up 11 trillion last year. And these are kind of all metrics at a high level, liquidity metrics that we would expect to support and have a similar outcome on a percentage basis, at least for Bitcoin. That diverged very significantly from about mid 25 to call it late Q3 25. Historically, at least all the time I've been in Bitcoin, we've seen every year that whenever there's a major move in gold of any kind of percentage basis, that Bitcoin will follow within sort of 2-3 months, give or take. And 2025, I'd say, is the only time that's not happened. I've kind of actively tweeted about that if you go through my posts every time it's happened, and it's played out like a textbook until last year. So that was kind of the first red flag for me, especially as we were approaching mid-year last year, where gold really started moving and just wasn't really getting a lot of traction on the Bitcoin front. The price action was very weak. And then that kind of just worsened massively into the second half of the year. I think, obviously, as we'll probably talk about, I think that's pretty much all driven by quantum, the quantum threat, which we can discuss in detail, but it's very clearly being priced in now by long-term holders and by institutions talking about it, by the fact you got Vitalik Buterin talking about it and setting up a quantum group for Ethereum. All sorts of avenues to that where it's just hit the mainstream. It's something I spoke about, obviously, in October near the top as the most significant threat to Bitcoin at this point. And you just don't have that risk with gold. So, and pretty much Bitcoin is the highest risk asset in the quantum front globally. So that's why I think it's just diverged from equities and gold significantly, especially when all the tailwinds, economic data, everything should support the growth of a hard asset like Bitcoin in this environment.
Yeah, it's an interesting situation because, the usual, the criticism that I hear of your stance and other people who are sort of raising this issue, like Nick Carter, is that Bitcoin would be the last on the list of threat of targets for quantum computing. I have also posted about this as well. I think, going back several years ago when I heard the criticisms around the quantum threat, I too also dismissed it. But I think there's definitely been changes from from the US government side as well, initiating changes to some of their cryptography standards, that suggests to me that the industry and government is already thinking about this and is already preparing. And you can look at, the large US banks investing in quantum computing to sort of signal that they are at least trying to either advance the technology and through that also make themselves better prepared. So I'm struggling with this as well, and I'm not an expert in the space. So I'll look at the literature that's being written, and I'm trying to sort of just balance the pros and cons of the situation. Yeah. So, what would you say to the criticisms that, of course, it's a threat long term, but everything is under threat with quantum computing?
Yeah, I mean, that's like, I suppose the concept that Bitcoin is as much a target as these other assets is a pretty common misconception. Bitcoin is the easiest target and the biggest honeypot. We can break that down. But if we just quickly cover off why banks or the government may not have the same risks. Firstly, obviously, there will be quantum hacks. Some of them will have problems. They'll have holes that money will get taken. There'll be a whole wave of probably quantum hacks across all different areas of life in the next sort of 5 to 10 years. But the biggest difference is that, firstly, these institutions are centralized, so they can upgrade quickly. A lot of them are already integrating quantum signatures in their encryption approach. They don't have to worry about being lightweight and efficient like Bitcoin, which is one of the biggest sticking points right now. Secondly, a lot of them, or pretty much all of them now, have 2FA. And 2FA, so when you use your password and combination and you've got a secondary device of 2FA, provided you've separated that and they're both well managed individually, that's quantum resistant straight away, because you only get a couple attempts at a 2FA code before you get locked out, or you have to wait, right? So the benefits of a quantum machine decrypting something like that is just not there, and that already makes it quantum resistant for many years, right? So those risks don't exist there. On the banking front, obviously, if you get hacked today, they'll get the money back for you effectively. In most scenarios, there'll be some form of insurance there. You just don't have that with crypto. Once the money's gone, it's gone forever, pretty much. So there's all these factors to consider and more as to why those traditional platforms are more secure today than Bitcoin. And probably the biggest one is just the fact that Bitcoin is built on trust, or being trustless money, right? Where you don't have to worry, just trust the code and it's all good. Once that trust is compromised because a quantum machine can steal funds or take Satoshi's coins, for example, I think that is when you'll get significant problems in trusting the code, if we haven't already upgraded. Now, I'm optimistic a lot of these things will be solved on before there's a significant loss of capital. So I don't want to be too bearish on that front. But the main issue is timeliness of an upgrade and getting a solution out before significant trust is lost. And I think what we're seeing in the market now is the market just discounting that risk, because we have entered that time horizon today where to upgrade Bitcoin will take, call it 2 to 3 years, including code agreement, consensus, and deployment on all active wallets. We can break down that timeline later, but the timeline for a quantum computer to have a non-zero risk of breaking Bitcoin's encryption is also 2 to 3 years now. So that's the main thing. I think you mentioned, a few years ago, you dismissed quantum. I remember, I think it was actually a Press and Pish podcast or a side note in a podcast back in 21. They actually talked about quantum. And around that time, I was thinking about it too, but it also looked 5 to 10 plus years away. And when it's closer to 10 years plus away, it's not really something that's worth worrying about in this sort of environment. But now that we're in the sort of 2, 3, 4 year horizon, it's definitely something to worry about, particularly given the lead times to upgrade Bitcoin. So again, these are issues that traditional infrastructure doesn't have, because they can, once they get consensus at a board level, they can just deploy tech straight away. So the primary risk factor to Bitcoin is just apathy of worrying about changing the code and the speed of actually deploying that upgrade.
Yeah, I mean, when I really was only looking at it for the first time, that was pre-AI, and now we're in this sort of acceleration period. So it seems to me like it definitely warrants more investigation. I think the other thing that I find curious about this is that a lot of the criticism, some people have sort of compared this to the FUD around the environmental impact of Bitcoin mining, which I was heavily exposed to where I was previously working, which were pushing a lot of that FUD. And just a simple exploration of the facts exposed that to be completely unfounded. In this case, what we're seeing, I think, which is very it's different, is that a lot of the criticism is coming from within Bitcoin itself. People are obviously, I mean, you've been in this space for a little while, and I can't speak to your motives around this, but I get the impression, Nick Carter maybe I can speak to, is that there are warning people who are sort of calling out the risks from within the network or within the community, not because they want to see Bitcoin fail, but because they want to see Bitcoin succeed. So, is that, what's your sort of take on, where the criticism or where the alarm bells are being rung from?
Yeah, great point. Like I've been in Bitcoin almost 10 years, and there's been no significant risks really, I don't think, to Bitcoin until now. That being quantum. I just don't think any of those other factors were ever that tangible or significant. This is something where if we do nothing, which hopefully won't happen, but if we do nothing, 20 to 30% of the coins that are publicly exposed will be taken by a quantum machine within the next 5, 6, 7 years max. And then that will be market dumped. So it's a huge supply unlock. If we do nothing, then from that point onwards, public and active addresses will also be targeted. So we're going to have significant structural issues if we do nothing. Now, hopefully we will, and action is being taken on this front, and that's really positive. But that's why I've talked about it, because I've been effectively all in on Bitcoin and crypto, pretty much just Bitcoin, to be fair, for that most of that time horizon, that most of the last decade. My fund launched as a pure Bitcoin and then ultimately crypto trading fund originally, because I saw initially when I discovered Bitcoin, especially 2017, I just read about it and I'm like, this asset's going to go to trillions. It's going to be massive. It's going to change finance forever. It was just obvious for me back then, the opportunity. I still think that upside potential is still there and to go beyond it, but we've never had a risk on the immediate horizon where that entire model could be compromised if we do nothing. And that's where we are today. So yeah, I've been tracking quantum for years. I studied some quantum physics at university a little bit. So I've always been interested and fascinated by it. It's a really exciting field. Like, we shouldn't be scared of it because the innovations that are going to be unlocked are going to just take science and innovation to a whole new level. It is really exciting the next decade. But in terms of crypto, it's something we just have to get on the front foot of now. And so I was seeing in the last 2 years, I'm like, I pop my head up about it occasionally, but I'm like, hopefully there'll be some traction soon. And just literally nothing was happening. And so then I decided basically mid last year, Q3 last year, I need to just go all in on this and be really public about it, because if someone doesn't talk about it, raise the alarm, we're going to address this at a later date, and the economic impacts for Bitcoin itself will be just catastrophic. So it's one of those things we kind of need to have the hard chat on to solve proactively now, so that we can have all the infinite upside and potential opportunities that we all want to see out of this asset class and to survive and thrive into the future. So yeah, I've only come about it because I want Bitcoin to do well, which is, I get a lot of criticism when I talk about this, and people just say I'm spreading FUD, and they think the opposite view, or that I'm just short the whole asset class. And that's not the case. Like, right now, to be fair, I don't have a position. We're flat on Bitcoin. Like, we traded actively. Like, so tomorrow we might open up a long, but we've been pretty much flat for the last few months. That's not necessarily just dictated by quantum, but our allocation as a fund in Bitcoin and crypto has come back because the risk is just too high to be fully exposed to this asset class right now, until there's a solution, or until at least we get broad consensus on the pathway to the solution, which I'm optimistic will be this year. And I think whenever we do get there, it doesn't have to be like full code or full alignment, but as soon as we get key Bitcoin core team alignment, or just key stakeholders in the Bitcoin mining space and key figureheads in Bitcoin generally aligned that, okay, we need to do something. This is probably the right pathway. Let's execute on it. I think once it happens, the risk just discounts like 50 or 80% overnight. And we probably see a significant repricing of Bitcoin up. But until we can kind of have those hard chats and get there, it's going to be a bit of a struggle. Yeah.
So a quick break in your regular programming. If you're serious about your future, grab my free report called Prepare for 2030. I think you've got 5 years to make as much money as possible, and this guide will help you navigate what's coming. The link is in the description. Download it now.
Yeah, look, I'm in that camp as well. I don't profess to be an expert here, but I think the discussion needs to get elevated within the community, and the sheer fact that Ethereum, is a totally different network with a totally different value proposition. However, nevertheless, have decided that they are going to devote internal resources to tackling this challenge, I think sets up a contrast between the two networks, which is going to be, in the eyes of institutional investors, whether the timelines are correct, whether the threat is even correct, does set up a juxtaposition between the two major networks in the crypto ecosystem and their philosophy on this potential threat. What exactly, you talked about getting the core developers on side. There is one proposal that I've seen that's looking to address the quantum threat. Why don't you talk about what that specifically is and whether it's gaining traction and whether it's enough?
Yeah, so good points. So if we're honest about crypto, they're basically all centralized except for Bitcoin. So the Ethereum example you gave is good. Like most crypto chains are running on centralized infrastructure, AWS. They sometimes have foundations like Ethereum, which basically run it and have make the decisions. So that is decentralization is the main challenge in getting consensus and agreement, and that is the biggest challenge for Bitcoin. Ethereum itself is probably more at risk from quantum because pretty much every transaction, smart wallet interaction has public keys exposed. So if they don't take action, they're in a really dire situation. So Vitalik spoke about that, I think it was November last year, probably just after we talked, that he thinks that both Bitcoin and Ethereum's encryption could be compromised before the next US election. And that's 2028, which is just 2 calendar years away. And that's not a lone estimate. The Department of War in the US has said that there could be quantum significant machines in that same time horizon. So I think the probability is not great that it's in 2 to 3 years. I think it's a small probability, call it 20 or 30%. So it's non-zero, but that by definition means that most likely it won't happen then, but it probably will in the next 5 to 6 years. But back to your question, what's being done? There is work being done. There's some core developers working on it. We're definitely getting more traction from people that were dismissing it in the past at Bitcoin mining companies. They've started to commit resources to it in the last 2 or 3 months.
Any of those the large public miners? I haven't heard anything on that front, so I'm curious.
So for example, Blockstream dismissed it. Now they're doing research publications on it in the last couple of months. Mara has invested, I think, into a company working on quantum resistance for Bitcoin. I'm sure there's more as well. The most important thing, though, is obviously getting the code right. So basically, they're called Bitcoin Improvement Proposals, BIPs, where an upgrade is suggested to the Bitcoin code. We then need to get consensus on that amongst the core team to roll that out. So that started. There's BIP 360 is the main one on that front. I am a little concerned today where it's all at because the hurdles they're facing, but also how that pathway has changed. Now, it's worth probably researching this, and you could spend a whole podcast on this independently. So I'm probably not the optimal expert to be talking about the code level of Bitcoin here, but BIP 360 was originally going to propose the quantum proofing signature methods and process, right? But now they've actually taken the quantum proofing signature part out, and it's kind of like a taproot upgrade, which is probably an essential stepping stone for quantum proofing Bitcoin, but it means there's another step we have to go through. I think that's because, and people have different views on this, but the signature method for solving quantum is not a straightforward decision to make. So generally speaking, so if people don't know, when you log in, just to really simplify it, to any platform, you have a password, and that password is used to do some decryption, right? For Bitcoin, when we talk about signature, it's when you're signing transactions. If we want to make it quantum resistant, it has to be a more advanced signature, which quantum machines can't necessarily break. So that's the very simplistic version of it. So to have a quantum proof signature for Bitcoin will typically mean the size of the signature in terms of megabytes or kilobyte space, right, is much bigger than classical encryption, like up to 10 to 100 times bigger. So this is not really a problem for centralized technology platforms today, but this is again another problem for Bitcoin because it's Bitcoin's code and block size is really lightweight, so it's been built to run extremely efficiently. If you have to increase signature size by 10 or 100 times, it means you have 10 or 100 times less transactions in each block, right? Give or take. But we're talking about orders of magnitude potential issues there. Now, there's some signature methods which could be more efficient and lightweight, and maybe that isn't really a problem. Maybe we utilize one of those in 6 to 12 months, and everything I'm saying now is not to worry about. But the more well-known kind of robust through time signatures typically are a bit bigger. And if we want to use something like that, then, do we discuss increasing the block size of Bitcoin to allow faster throughput? Now, that's something, obviously, those who've been around for Bitcoin in the last 10 years know the block wars were quite a challenging period. So we've got multiple fronts of discussions that need to be closed on here from a technical and consensus point of view. Just to upgrade, and this is for active wallets and users typically, to upgrade to a quantum proof signature method. But yeah, there's a lot of work being done. As I said, I think just in the last 2-3 months, mining companies are dedicating resource to it. I'm sure others are as well, probably in the banking, treasury company sector as well, if not publicly behind the scenes. So I'm very optimistic that this year is the year that we get significant traction from the tech side of things to a roadmap to roll something out, or at least have the roadmap to do it. And that will just, like I said, very quickly blow away a lot of the risk that's associated with this. The main thing for me is I just want to see that publicly to diminish some of that risk. And we just don't have that yet. And in fact, it's, for me, quite cloudy, even for someone who's in the space. So long story short, there's definitely a pathway. It's all solvable from a tech point of view. It's just the biggest thing is, this is a big network with tens, hundreds of million people on it. And to get consensus and alignment on something where people are very stoic and philosophical about not changing the code is quite challenging. So that's the main hurdle we have to get over. It's definitely doable, but it's probably the biggest upgrade challenge that Bitcoin's ever had.
There's that aspect as well. But the last thing I just wanted to ask you was regarding like the Satoshi problem with the original coins, the most exposed coins on the network.
Yeah.
How do you think it should be tackled, in your opinion? Because this is extremely contentious because it goes to the core of Bitcoin's philosophy about property rights. So maybe walk us through. I mean, we've had Franklin Templeton on talking about their recent research into the problem. So I think most people on Real Vision have probably seen that and are familiar. But I think for those that aren't familiar with the topic, it's probably worthwhile just discussing that aspect. It's a major thing. But just walk everyone through what exactly is the problem, and then your opinion in terms of how it could be or should be solved.
Yeah, great points. So everything we've talked about so far this episode is purely about managing risk for the active users. So you and I or whoever else is around transacting in Bitcoin, because effectively that solution and code upgrade is all about migrating people across to a new signature method wallet system to protect their current assets. And that's probably 80% or 70-80% of the network globally. So there's 21 million coins. It's roughly 70 to 80% of that 21 million coins that are active and can upgrade and we can solve that risk from a technological point of view. The more challenging, at least philosophical debate is the remaining 20 to 30% of coins, as you mentioned. That is the coins that are public key exposed. What that means is that on the blockchain ledger, their public key is there. And if you have a public key that is visible, it means a quantum machine can decrypt it if it hasn't migrated to a quantum proof signature. Now, most of these coins, as far as we're aware, are either lost or effectively the owner is either dead or they've lost the keys. An example would be Satoshi, roughly 120 billion worth of Bitcoin, dollars-wise, that is in his name. And then you've got about $500 billion, give or take, depending on the price of Bitcoin, which is a bit lower today, but that is locked up in these other public key exposed coins. So how do we solve that? If those owners are not there to move the coins and manage the risk, that's a real problem. So sometimes you talk about, you hear people say things like, I think Mark Saylor actually said last year that he'd burn a bunch of coins at some point, like as a positive thing for the network, but it's actually bad because if you don't have coins,
did you say?
It's something something about like a long-term plan, something for burning off coins and
okay, yeah,
as like almost like a charity type thing, right? To strengthen the network, right? But like that, dead coins are actually the worst because if they're not actively managed, you can't upgrade. And right now, obviously, quantum is the existential threat to Bitcoin, but long-term, who knows what it is in 10, 20, 30 years. Code has to be upgraded all the time and improved against threats. But so the 20 to 30% of coins that are public key exposed and who probably will not be upgrading their wallets because they're lost, they're in landfills, the owners are deceased. That is a problem because they will definitely be taken by a quantum hacker within the next 5 to 8 years, call it maximum. So like, what do we do about that? Do we let whoever it is, some massive quantum company in China or wherever, take these coins and just market dump them? Because if you're to think of it from a game theory point of view, there's about 60, give or take, quantum companies in the world today, including hybrids. I call them hybrids. It's like your Amazon, Googles that have quantum departments. There's probably a lot more private that we don't know about in places like China, given they're spending double the US on quantum. Now, at some point, one of these companies is going to have the capability to break Bitcoin's cryptography, probably within that sort of 5 to 8 year horizon maximum. So if you've got that capability, there's, call it 50 or 60 other companies behind you trying to do the same, not do the same thing, but generate the same capability in quantum, you're going to move to unload those coins as soon as possible. Not that you lose them. Especially when you know that the network is compromised, if it is at that point in time. So the game theory is that you don't hold the coins like some people are suggesting, you dump them as soon as you can. That's the other risk factor for Bitcoin is like in banking, you've got all sorts of processes and timelines and money can be locked, right? In Bitcoin, if you have access to a bunch of coins, you can liquidate it 24/7 on one of 100 or 1,000 different exchanges that will support you. So that's why it's a big honeypot, because the entire last decade of quantum computing research can be funded plus more just by unlocking these coins and dumping them. So what would that do? That would mean complete, I think, loss of trust in the code, because anyone who's not in Bitcoin, it doesn't matter what you think. If you just see, okay, there's $500 billion just been unlocked and it's slowly selling over whatever it is, a month or a week or what have you. Like, are you going to trust the code that this is hard money and a store of value? I don't think so. So, all this stuff is, we can get through it, right? It could just be a huge bear market where we just say, okay, we accept that risk. We accept that 20 or 30% of coins could get dumped at some point. There's a big bear market. We go through it and we're left for the final 80 and we continue on. It doesn't mean the death of Bitcoin, but as we all know, trust takes a long time to earn. It's taken Bitcoin, whatever it is, 16, 17 years to get to a couple trillion. A lot of trust would be lost overnight in an event like this. So
it almost seems like the the market has to start pricing it higher and higher as a risk, so that it really does start to catalyze some discussions and some change from the internal Bitcoin community.
Yeah, and this is not an easy one. There's no right or wrong answer, I think. So the only real option, if we want to reduce the risk of that scenario, is once the code is upgraded for quantum proving signatures, like we talked about, that manages the active addresses. For the final 20%, we could have another proposal, or the same one, which basically says any of those coins in these wallets, these public key exposed wallets, if they do not migrate to a quantum proof wallet before some deadline, maybe it's 2 years, or it would be a block height, but you give some time deadline of 18 months, 2 years. If you haven't migrated by that point, those coins are defunct and non-transactable on the network. So that is the other extreme solution, which basically means everyone has a time limit to upgrade. And if you haven't, then the coins are useless. So in that scenario, there's no possible way that a quantum hacker could take those coins, provided obviously we get the timelines right and they don't break the cryptography before that, whatever that deadline is, say it's 2 years. So I kind of prefer this proposal. I know a lot of people don't like it. I know it's not perfect because there are some risk factors there. But I think it's the lesser of two evils. And it really comes down to the philosophy of what do we being a collective, every Bitcoiner in the world, what do we think Bitcoin is and what do we think the primary value prop is? And everyone will have a bit of a different point of view. Obviously, the original paper by Satoshi was a e-cash system, right? I would argue today it's more like a digital gold, a store of value. And for me, the most important value prop of Bitcoin is that it's a hard money, that there's only 21 million coins, that it's an inflation hedge in a world where banks are printing right now today globally more than 10% of the money supply on an annualized basis, which is crazy. So for me, the most important thing is it's a store of value where you can protect your capital against the melting ice cube of the fiat dollar. And it's a better gold because it's transactable every day, that sort of thing. So for me, they're the main value props, and primarily it's the hard money, the 21 million coins. There's other philosophies and value props in Bitcoin, like, for example, not your keys, not your coins, custody rights, moving capital in your head with a seed phrase in theory, although I don't know anyone who's actually done that over international borders. So there's other value props there. And if we were to say, okay, if you haven't migrated your coin to a quantum address by, call it 2 years from when the code's deployed, that you've lost those coins, that would be basically killing the not your keys, not your coins philosophy. Because, for example, if you're locked in prison and maybe you're innocent and you're in prison for 10 years and you can't move your coins, then your money's gone. So the keys are not really, your coins are not owned by those keys anymore, so to speak. So that's the argument against this, is do nothing because we want everyone to have their property rights. But I think the bigger value prop is do something because we want to maintain the hard money, 21 million fixed cap supply philosophy of Bitcoin. And an unlock of 20 to 30% of supply to a hacker with coins flooding the market, I think that would kill the trust in the biggest value prop for me, at least for Bitcoin. Now, I'm not sure that we'll ever get consensus on this. I think if I was to guess, the most probabilistic outcome is that nothing will happen here. I think we're just going to let that 20% of coins sit where they are and accept that most of them will get taken by a quantum hacker over some time frame, because it's really hard to get consensus on this philosophical stuff for Bitcoin. Again, there's no right or wrong answer. I just think for me personally, the lesser of two evils is like accept that 0.001% of people in the world who own those coins maybe can't access them and might lose them, to save the other 99.9999% of Bitcoin users and their value prop.
Yeah, there's no easy solutions here. And look, I mean, for those who are watching, I copped a little flack for a post that I put out a couple of weeks ago on this topic. And it comes from, I think, a good place in terms of just wanting the network to succeed. And I think the problem is substantial enough to warrant like a very, very vigorous dialogue in the community. Maybe we'll see Satoshi come back. Like, weirder things have happened. Not that that would address the entire problem, of course, but it would, I guess, mitigate some of the risk in terms of that large exposed coin base. But whoever they are, if they're alive, it's their prerogative. I think the community will have to take action and not wait for that white horse to sort of come in. The other side of this, and I've been thinking about and talking about as well, and for your knowledge as well, at sort of Real Vision, I have a large stake in Bitcoin. It's my largest core holding. So, I'm very interested in this topic for obvious reasons, long-term viability, but also because, I'm quite exposed to it. The way I've sort of been thinking about it is there's potential really to take the other side of this and hedge it a little bit with the quantum computing stocks. Now, those stocks actually ripped very, very hard last year. And I know that you've got exposure to quantum computing stocks, so you should probably address that as well, because that's going to be a criticism that's leveled at you for bringing up this point of contention around the Bitcoin network. But I'm interested to know how you think about investing in quantum computing stocks and also addressing that criticism.
Yeah. All right, let's start with the criticism. So if you rewind a couple of years, I was basically 100% in Bitcoin, managing positions. So sometimes long, sometimes short, but basically net long. As this risk grew, I just realized you have to have some kind of hedge, right? Obviously, one part of that hedge is talking about it publicly because we need to upgrade the code and get a solution. And the other part is managing the risk if it does eventuate. I'll just pull down the blind because the sun's come right out.
Yeah, I can see it.
Can bear with 1 second.
Well, look, I mean, it's amazing that you're getting some sun in Melbourne. It's not known sunniest of cities.
Yeah. So I just needed a hedge if that risk eventuated or until it was solved. And so that's why the first reason I kind of really put some diversified exposure into quantum. But that, me talking about the risk to Bitcoin does not help quantum stocks. The value prop of quantum is not to hack Bitcoin. With the stocks you can invest in, public equities, they can't go and steal Bitcoin and benefit from it. And even if they could, me talking about them theoretically taking Bitcoin in 4 or 5 years is not going to benefit their stock price. Like, the value prop there for quantum is like innovation across every asset class. It's discovering new materials, drug discovery. It's used today. It's been proven in many trials to help, with AstraZeneca in drug discovery. It's process optimization across supply chain, finance, medicine, anything where there's an optimization process or a problem-solving element. Quantum can do it infinitely faster. So it's actually a really exciting field, and it's the field that I'm most bullish on as a kind of technology growth pathway over the next 5 to 10 years. And that's completely irrelevant to Bitcoin. Like, whether or not Bitcoin solves this or not does not make quantum stocks go up at all. They're completely, quantum's actually gone down the last few months. So it's completely untied to this. Ever since I pretty much started speaking about the quantum threat to Bitcoin, I think quantum's gone down. So I think that theory doesn't hold water at all. So that's kind of...
How would you invest in the space then? Because there's so many sort of frontier companies that are working on the quantum computing challenge. Are there any leaders in the space at the moment that you would hire?
Yeah. I mean, so it's really it's a complex field because you have some big players, but if you look at them all, they're basically solving it at very different angles. So some, at the atomic level very differently, neutral atoms or, various different systems to come about it. And no one knows which one is going to scale to be, at a manufacturing level to be, that's something that can really expand to take off. So there is definitely risk here. And, some of them need to be cooled, like ultra cooled. Some can be at room temperature, all sorts of factors to consider. It's very early days in that tech journey, but in each of their own rights, they're progressing at an exponential rate. So we all know Moore's law, where transistors have doubled in capacity every 2 years. So for quantum, it's doubling every 18 months. So it's faster. This is the qubit processing power rate of quantum machines. The error rates are also falling exponentially. So, the tier one companies, and there's probably about 6 or 7 of them globally, which are really the biggest leaders, I suppose. Probably half of those are still private, and a couple are public. They have been, progressing on that pathway where they're expecting multi-hundred or multi-thousand logical qubits by 2029, 2030, 2031. So, less than 5 years. That's enough to break Bitcoin, but it's also enough to solve a lot of really exciting innovations and, a lot of exciting stuff will come out of that. McKinsey, the biggest consulting firm, or biggest brand name, probably consulting firm in the world, they kind of put quantum computing at a $2 trillion economic value within a decade. And that was published 2014. So within 8 years, right? And that's kind of the outer threshold. So that's why I find it really exciting. And so, to answer your question, how do you allocate to it? I think right now it's not as clear cut as one winner. You kind of have to have a diversified approach. We spent a few months researching and modeling this last year, and built a quantum index, which is live on our website, capriole.com/charts. And it has all the constituents in there as well. We looked at many different fundamental factors to weight that index. And we ensured at least 50% is pure quantum companies, and then the rest is made up of hybrids. So your Googles, Amazons, etc., that have a significant quantum department. So that's how we're kind of doing it, is that index approach. But at the same time, there's also some really interesting private company opportunities in the quantum space, which we're kind of looking at as well for future opportunity. But I think today you need to be diversified. You need to probably rebalance quarterly or half yearly to allow for the new leaders in the space to evolve over the next few years.
Okay, so let's switch back to Bitcoin for just a second, because another thing that you've been raising as a concern has been the state of the Bitcoin Treasury company market.
Yep.
So why don't you talk about what you're seeing in terms of the data, because I know you track a lot of the key metrics for these companies. What's your sort of view as to where they stand today?
Yeah, so this is a big topic. So the Bitcoin Treasury companies, there's 200 today, unbelievably 200. These are public companies that more or less their mandate is to just acquire Bitcoin through any means possible and grow their Bitcoin stack. And generally they try and sell that to the market as generating Bitcoin yield. So some kind of return on investment on their Bitcoin in a Bitcoin basis. Now, at a fundamental level, for me, this is challenging to accept because Bitcoin is fixed supply, it's 21 million. So you cannot grow yield forever, especially if there's 200 of you doing the same thing. It's physically impossible. You can do it for a certain amount of time until you get market saturation. But then how do you do it? So a lot of them are basically saying, we'll issue equity to buy more. And that works when your Bitcoin balance is worth less than your equity because it's not dilutive to your shareholders. So people use the term MNAV, which basically means the multiple of what your company's worth to your Bitcoin. So when that falls below 1, when your company's worth less than your Bitcoin, you can't issue shares because it's dilutive to your shareholders. Or you can, but everyone will leave your your company and your investment. Your only real option at that point is debt. And so that's where long-term this model breaks down because there's no justification to trade at a premium to your MNAV, to your Bitcoin holding long-term, because you can't generate a yield forever, especially if there's 200 of you. Now, you could argue there's 1 or 2 companies in there. Maybe Michael Saylor and Strategy is one of those where they can unlock great innovations, service markets that others can't, generate yield through innovative products. I think there's limitations to that, and we've already seen their yield is broadly collapsed as well, along with all the companies. So there's probably a world where some survive, and I think ultimately they evolve into really banks where they're borrowing and lending Bitcoin to generate the yield, as opposed to trying to do it through alchemy of equity and debt. So I do think that what we call treasury companies today won't exist in 5 to 10 years, but there will be some left, call it 5, 10, who knows, that are basically have evolved into banks. And they might call themselves Bitcoin treasuries, but they're really generating yield and flows of capital through other means. So that's the kind of core thing. The issue with the model today, when the MNAV's below 1, and as it has been a greater and greater percentage of companies falling into that criteria today, they basically can only use debt to grow their yield. So if you're treasury company number 200 and you're trying to raise capital and grow your business, and you've got 199 companies next to you doing the same thing, how do you stand out? Like, you have to take on debt to pump up your holdings and grow your yield and say, look, my yield's better. And I think that is where the incentive structure breaks down, because if this is extended far enough through time, you'll see debt ratios just continue to climb, as they have been climbing the last 6-12 months.
Tell me how many of these companies have actually raised debt. I mean, we know MicroStrategy has, or Strategy, MetaPlanet has, but do you have like a percentage of the total 200 companies that are now in existence that have actually got debt instruments attached to their strategy?
Yeah, I mean, I can show a chart, but basically, we have about 20 to 30% of. Yeah, I'll just share it a second. You see that?
Yep.
So we have about call it 20 to 30% of companies with a debt to enterprise value ratio over the sort of 20 to 40% region. Depends how you cut it. You can measure debt on Bitcoin holdings or debt on equity, etc. But it's broadly been climbing through this bull market from, call it 5 to 10% to 20 to 30% of companies. So yeah, these companies are using debt. It's still pretty modest, right? Like, this is not a concerning threshold. This is what you might see in a typical company, these kind of levels. It's just, for me, the incentive structure is to drive this higher over time. And that could take years, right? Like, we can talk about I like to talk about the 1920s trusts. They were basically vehicles that bought stocks, traded at a premium. They bought the stocks because they said they were limited in supply. And that was their entire business model, was just buying stocks and using leverage and equity to do that. And they ultimately blew up and are a large reason for the 1930s crash. So we're a long way from that, because the multiples are still quite low, but they're growing. And that's why I just don't see this as a sustainable model, because you cannot generate yield on 200 companies. Like, we don't even, if you just cut it to the most basic level, do we have 200 gold treasury companies? Gold's been around for thousands of years. No. Do we have 200 ETFs? They're kind of like ETFs, but trying to generate a yield. And the answer is no. So it doesn't make sense, especially for Bitcoin. If we talk about something like Ethereum, there's some arguments you can have for it. Like, obviously Ethereum, you can stake it and as a yield, that's different. So if that's your model, fine. But again, is there a world for 200 Ethereum treasury companies? No, I don't think so. So I think that market broadly for both Bitcoin and ETH consolidates a lot over time. And the question is just, how far do we let the bubble run? Now, the only reason this is legal today to even do this, to have a Bitcoin treasury company, is because Bitcoin is not considered a security. So the 1940s Investment Act eliminated companies from doing this, and it applies to securities. So Bitcoin being a commodity or a different asset class, as you will, it isn't covered by that act, and that's the only reason this is legal today. So I find that also quite interesting, because it's the exact same business model.
Look, I think the other major component of the Bitcoin network is obviously the miners. We've seen a pretty big reduction in hash rate over the last 3 or 4 months, and obviously the weather pattern that hit the US in the last couple of weeks played a role in the large fall that we've seen in just the most recent weeks. But essentially that decline started all the way back in, I think, October. I ran some numbers on it the other day. It looks like it's the third or fourth largest drawdown in hash rate in Bitcoin's history. And obviously we had the largest one in history was mid 2021 with the China ban. What's your sort of thoughts on where that segment is? Because, in order for hash rate climbed dramatically in 2024 and 2025, and at least up until, let's just say, the end of 2024, the price was sort of matching the hash rate, so profitability was still pretty strong. But obviously, as price starts to decline, and given the amount of compute needed to mine a Bitcoin, that means that margins start to get compressed. What's your current take on the overall situation with the Bitcoin mining companies, and are we near sort of capitulation levels or stress levels? And what does stress levels look like to you in terms of the data?
Yeah, so I recently tweeted about the hash rate collapsing, like you say, pretty significant percentage. Like the stats you mentioned are right. Like it's the biggest one since China banned mining, basically. It's not that bad, but it's big. And generally, that's not good for Bitcoin. Like we have a few valuation metrics based on hash rate, like energy value, which has tracked price really nicely for the past. I can just share it maybe for a better visual quickly, but so yeah, this is energy value, which is we created this 7 years ago and it's not changed, and it's just been a really good track of fair value for Bitcoin over time. It's just purely pricing Bitcoin based on joules of energy and nothing else. And when hash rate collapses, if you value it this way, then the value of Bitcoin falls as well. You can also cut this just simply production costs, probably more useful for what you're talking about. So this is the cost of the red line here is the electrical cost for Bitcoin. This is basically the global average electrical price of mining Bitcoin multiplied by the energy used to mine Bitcoin globally, which is precise based on hash rate. And it's been a historic price floor for Bitcoin. We've only dropped through it for a couple of days through Bitcoin's history, like March 2020, when Bitcoin dropped about 50% in one day. And every time it's been a really great buying opportunity because it's at that point, miners have to turn off their rigs if they want to operate long term because they just can't even afford the electricity they're running it on. The orange line adds in about a 20% profit margin, or a bit less now, I think it is. But a multiple to allow for operating costs. That's your warehousing, your physical infrastructure, etc. Right. So whenever we drop below the orange line, which is production cost, these miners are, broadly speaking, losing money. Now, the most efficient are obviously still making a lot of money. The least efficient are losing a lot of money. This is an average. Again, it was created back in 2019, so 7 years ago, and it's worked really well as a value zone for Bitcoin. Now, that number's falling. So technically today, these companies are still quite profitable. What does that mean? It means there's been capitulation already. So the poorer, so the least profitable companies have already pivoted or turned off their rigs or what have you. And that has dropped the floor price because you're left with more efficient companies. This happens a lot every time hash rate collapses. So we're left with a more efficient base, which means that they can withstand a lot more of this sort of pain, if you will. And they're still very profitable. So it also means that the floor price that price could go down to is also expanded. So for me, the real value zone is when you're in this band, which is currently 53 to 66K. We don't have to get there, right? Like we could go straight up from here. I'm not saying we go there. I'm just saying that the deep value opportunities we've seen every cycle, every few years, are in that zone. So I would get very excited when we get down there for sure. But yeah, hash rate's been falling. People blame the storm, but it's still falling on average. And it's been falling since November, so for almost 4 months. So I don't think a 1 week storm is to blame here.
Yeah. Okay. So, I mean, what's your outlook then for the rest of the year in terms of just sort of the macro outlook? We've got obviously a new Fed chair that's been announced. We've got a striking sort of divergence in the US economy, with unemployment sort of ticking up a little bit, but you're seeing some very worrying headlines from large tech companies about hiring and also firing. And you've got sort of like this business recovery in the ISM numbers. So obviously, at some level, we're starting to see big improvements on the manufacturing side. So do you have sort of like your thoughts in terms of positioning from a sort of macro multi-asset sort of perspective for the rest of 2026?
Yeah, macro broadly, still very positive. And a lot of that, we look at markets top down. So from a liquidity point of view, Fed and economic data, then flow all the way downstream, equities, commodities, fundamentals, sentiment, price data, etc. So from top down is really the main driver for markets globally. You guys, I think you talk about this quite a bit in Real Vision too, but money supply has grown globally 11 trillion last year. That's the highest growth rate since literally mid 2020, when stimulus checks were falling down on people to pump money into a stalled economy. So we have huge money supply. That's the first thing. And then we have a supportive Fed, I would say, broadly. So even before this new chair came in, the Fed is targeting 3% rates over the next sort of 18, 24 months. Obviously, that could change a bit now, but the new chair that's come in is obviously pretty closely tied to Trump. And economic policy kind of at all the top echelons in the US is really liquidity orientated right now. So obviously you got Trump. He wants lower rates generally. He's done things like trying to cap credit card limits, all sorts of things to pump liquidity into markets. And that's also driven by the midterm elections, which are coming up in the next months. And he needs a strong economic win through that period to maintain a lot of power. So he's going to be driven, especially in the next 6-12 months, to expand liquidity and economic outcomes for people. You've got Besson and the Treasury account also doing really supportive liquidity action with MBSs. And then you've got the Fed as well, lowering rates. They started growing their balance sheet as well by 40 billion a month just a month ago. So everything kind of from a data point today is really pro liquidity into the markets, and from like a policy and like forward looking outlook of these key leaders in the market is also, I would say, pro liquidity. So I think that's really positive for especially risk assets, equities, and hard money, gold, Bitcoin to an extent, but Bitcoin obviously has these other risks it needs to resolve to kind of get into the same playing field. So I'm really positive at a macro level in that regard at the moment. I think one of the bigger risk factors, all this depends on time horizon. Like if you're talking 5 years, then that becomes a bit more of a question mark, especially in the equities front, where we have pretty extended valuations at the top level. And we have things like gold massively outperforming and equities. So typically when you have gold outperform equities over the long-term horizon, I like to use a 200-week moving average, you get these regimes of 5 to 10 years where gold typically does great for that 5 to 10 years. And we're only 1.5 years into that. And in every time that's happened, 1930s, 1940s, 1970s, and 2000s, gold went up on average 150% from where it is today. In that same periods, you had the biggest bear markets in equities in history. And you basically, in hindsight, through that 5 to 10 year window, would not want any exposure to equities in hindsight and would rather have just been 100% gold. Now, I'm not suggesting to do that today. I think equities have higher to go here at the moment. But the risks are widening if you've got a long-term horizon, for sure.
Last question. Curious to know, like with all the people that we speak to on Real Vision, like what is your current AI setup? Have you gone into the open source world and started using Maltbot or OpenClaw, as I think it's now been renamed? What LLMs are you preferencing in your workflow that's been really beneficial to the fund?
Yeah, great question. We've been using AI basically from inception. before the LLMs became mainstream, we were doing a lot of research with reinforcement learning. We're building models out of that. We've obviously been using ML as well for years. But when the LLMs came out, obviously that was a real game changer. From our own business perspective, like in terms of our capability and productivity, it just like doubled pretty much in a matter of months. A lot of what we do is code, right? Because we're acquiring new data, building new models, backtesting, building new data pipelines, building charts platform, all this sort of stuff. And the coding interfaces and the integration with AI today is really amazing. Even just ChatGPT or any of these kind of platforms are, in their own right, are great for productivity enhancement. We've really seen that. So I would have imagined our team would be a lot bigger today if you'd asked me a few years ago, but we just don't need it. And we're probably more productive with a smaller team with this AI capability. So that's been really good. From the investment side, we've also been doing a lot. We just released the first AI model on our platform, charts platform, a couple months ago, which basically is processing all of our metrics, over 200 different metrics, models, strategies. For each metric and model is over like 40 different data points on its forward-looking returns, correlations, skew, all this sort of data. All of our research papers of publication, over 20,000 pages of documentation, feeding that into LLMs and using it to recommend a confidence score for which way the market will go over the next week or the next 30 days. Because that's the time horizon we're kind of interested in our fund, which is directional. And we just built a time series model out of that, deployed that just last night actually on the platform. It's the first version. It'll change a lot. It's a beta, but really exciting stuff. I think the pathway for us is to just continue that journey, advance it significantly in the coming months, and long term, the fund could be a full AI fund, making all the decisions based on tons of data and proprietary metrics and models. So yeah, we've been heavily in the AI space. In terms of individual LLMs, I mean, they're all very good at this point, and every few months the leader changes. So you got to kind of be fluid to that. I think Google Gemini Pro 3 is the best at the moment, especially for us, because it has massive capability in terms of the tokens it can take. So it can take a few million tokens. So we can throw it at, like I said, like 30,000 pages of content and metrics. You just cannot do that with any of the others today. That'll change in a month or two. So, but it's definitely the world leader and benchmarked. It's basically crushing ChatGPT at the moment. But all this is very fluid. But we're pretty agnostic. We use multiple frontier models in our coding. We will be expanding this to leverage multiple at once into more of an ensemble model approach. So we're going to see a lot of changes in how we do it, and it's going to evolve a lot in the coming months. It's definitely very exciting for investment management.
Fascinating time. Okay, look, Charles, I really enjoyed today's conversation. Definitely left me with a few things to ponder about. And I think these conversations are always difficult. You're always going to be, when you're sticking your head up above the parapet, always getting shot at. So I admire you for being sort of a controversial figure, speaking about it early in the piece. We can debate the timelines, we can debate the threat, but I think that is what ultimately is healthy, is having the debate. So thank you again for joining us here on Real Vision. Hope to see you soon, and see you later, everyone. Join you in the next.
Yeah, thank you. It's been a lot of fun. And that's a great point. A lot of it doesn't really matter when it's a risk. Like, we know it's going to happen because there's been no scientific roadblocks. It's progressing. And the timeline doesn't really matter. It's the discounting. And as everyone knows in investing, all markets are about discounting future value. And if you have to discount because of risk, you have to discount the value today. And that's what we're seeing. And that's why we need to talk about it and get on the front foot and solve it before it becomes anything significant. That's what I'm trying to help do.
Agreed. All right, Charles. Thanks very much. Goodbye, everyone. Have a good day.
Thanks, everyone.
So you obviously like this video enough that you've got to the end. That's quite a big task. But listen, do me a favour hit the like and subscribe button, and also check out what video's next, because I think you'll love it. But if you want even more, and when I'm talking more, I'm talking about member-generated ideas, incredible alpha, research, everything there to help you in your journey, just head to realvision.com/join for the best financial intelligence out there and the pure alpha that's within the platform.